Markets don't pay you for being right. They pay you for taking compensated risk, providing liquidity when others can't, and surviving long enough for time to work. The fastest way to lose is not bad picks. It's a cash flow structure that forces you to sell at the wrong time. Wealth is built by controlling your time horizon, your liquidity, and your risk of ruin, not by chasing the hottest return. Today, you're going to audit 10 money habits that separate a fragile financial life from a durable one. And we're going to treat it like a private investment lab. Inputs, constraints, positioning, and execution. Start with the core mechanic. Every financial decision is a trade between liquidity now and optionality later. Liquidity is your ability to meet obligations without forced selling. Optionality is your ability to act when opportunities appear, buying assets when they're cheap, funding a business move, or simply not panicking. Most people think mindset is motivational. It isn't. Mindset in finance is the set of incentives and rules you obey under stress. In market terms, it's your positioning and your risk limits. If your rules force you to sell low, your mindset is irrelevant. The system will break you. If your rules keep you liquid and sizing correctly, you can be wrong often and still compound. Habit 1 is liquidity first, not returns first. Poor behavior is to invest as if money is a one-way door. Deposit into something risky and hope life doesn't interrupt. Wealthy behavior is to treat liquidity like margin for living. In markets, margin calls don't care about your long-term thesis. If you're leveraged, financially or psychologically, volatility becomes fatal because it demands action at the worst time. The biomechanics here are cash flow timing, rates, and volatility. Your paycheck arrives on a schedule. Your bills arrive on a schedule. Asset prices do not respect your schedule. Wealthy operators build a buffer so volatility can't force liquidation. Most investors misunderstand this because they idolize high returns and ignore the path. They look at annual performance and forget that the path includes drawdowns, job loss risk, medical shocks, and interest rate resets. Here's how you apply it in the lab. You define your personal maintenance margin. Calculate your non-negotiable monthly burn: housing, food, utilities, minimum debt payments, insurance. Then you build a liquidity reserve that covers that burn for a predetermined window, not because it feels safe, but because it prevents forced selling. If you hold risky assets and the market drops 30% while you lose income, you respond by living off liquidity while your assets recover, not by selling at the bottom. If rates rise and your variable payment increases, you respond by extending liquidity, not by doubling down on risk. You also keep the liquidity in instruments that behave like liquidity: high-yield savings, short-term T-bills, money market funds, places where the bid-ask spread and duration risk won't surprise you when you need cash. The failure point is ego. You'll tell yourself cash is lazy. In reality, cash is a derivative of control. It buys you time, and time is where compounding hides. Habit 2 is you pay yourself first, but you define yourself correctly. Poor behavior is treating saving as what's left over after spending. Wealthy behavior is treating saving and investing as a fixed obligation, like rent, because you're buying future cash flow. The market mechanic is simple. Capital accumulation is a function of savings rate and return over time, but the savings rate dominates early. The biomechanics are incentives and automation. If you rely on willpower, you'll lose to friction and temptation. Wealthy operators don't argue with themselves every month. They set a system that executes. Application looks like this. You set an automatic transfer that happens the day income hits, not the day before bills. You choose a percentage that is aggressive but survivable, and you ratchet it when income rises. If your income is volatile, you use a base transfer plus a variable profit share transfer. If the market is frothy and you can't find good risk-adjusted entries, you let cash build. The habit is the transfer, not the immediate deployment. If your spending starts creeping, you don't try harder. You cut the number of decisions. You move discretionary spending to a separate account with a weekly limit so it can't bleed into the investing account. Failure point. You'll try to optimize returns before you optimize contributions, which is like tuning a race car with no fuel in the tank. Habit 3 is you buy assets, not lifestyles. Poor behavior is using income increases to buy recurring expenses that permanently raise your burn. Wealthy behavior is using income increases to buy cash flowing or appreciating assets that lower your future burn or increase your future income. In market terms, you're choosing between a liability stream and an asset stream. The biomechanics are cash flow and rates. When rates are high, liabilities are heavier. When rates are low, leverage is tempting. Most people misunderstand this because consumption gives instant feedback and investing gives delayed feedback. The market rewards delayed feedback, but your brain prefers immediate reward. In practice, every time you consider a recurring expense, you run the cash flow test. If I commit to this monthly payment, what asset could I buy instead that would cover it? You don't need the asset to fully cover it today. You need a plan where future cash flow absorbs future lifestyle. If markets sell off and high-quality assets reprice lower, you respond by redirecting lifestyle drift money into the opportunity, not by maintaining appearances. The failure point is social comparison. You'll anchor your spending to someone else's highlight reel and forget that most wealth is quiet because it's allocated, not displayed. Habit 4 is you think in time horizons, not in moods. Poor behavior is making financial decisions based on recent price action or recent emotions. Wealthy behavior is matching each dollar to a horizon and a purpose. Market mechanics. Short-term prices are dominated by liquidity, positioning, and narrative. Long-term prices are dominated by cash flows, productivity, and valuation. The biomechanics. Volatility hits your nervous system, and your nervous system tries to shorten your horizon to escape discomfort. That's exactly when you make bad decisions. Here's the lab version. You separate capital into buckets that are not allowed to contaminate each other. Near-term liquidity, medium-term goals, long-term compounding. Then you assign different instruments and rules to each. If the market drops sharply, your long-term bucket doesn't suddenly become rent money. If you need money within 12 months, it doesn't go into volatile assets because your entry and exit are dictated by a date, not by the market. If the market rallies hard, you don't move your emergency fund into stocks because you feel behind. You keep the horizon discipline. The failure point is mixing horizons. People say they're long-term, then behave short-term when volatility shows up. Habit 5 is you respect price, not stories. Poor behavior is buying narratives and rationalizing valuations. Wealthy behavior is understanding that price is a function of expectations, and investing is paying a price today for future cash flows under uncertainty. Market mechanics. When rates rise, the discount rate rises, and long-duration cash flows get hit harder. When liquidity tightens, assets with shaky fundamentals get repriced violently. The biomechanics. Your brain loves coherent stories. It hates probability. Most investors misunderstand because they evaluate investments like identities. I'm a tech person. I believe in crypto. I'm bullish on AI. Markets don't pay beliefs. They pay the spread between expectations and reality. Application is scenario logic. If rates are falling and liquidity is expanding, high-growth, long-duration assets can outperform, but they also carry sharper drawdowns if the regime flips. You respond by sizing these positions smaller and defining exits earlier because the volatility regime is part of the trade. If rates are rising and credit conditions tighten, you prioritize quality balance sheets, pricing power, and shorter duration cash flows. You don't need to predict. You need to position so you can be wrong without blowing up. You watch information signals that matter: policy rates, credit spreads, earnings revisions, and liquidity conditions. You exit when the thesis breaks, not when your feelings do. The failure point is anchoring to the purchase price and refusing to admit expectations changed. Habit 6 is you use risk limits like a professional, not like a gambler. Poor behavior is all-in thinking, oversized positions, and vague exits. Wealthy behavior is position sizing, predefined risk, and rules that prevent catastrophic loss. Market mechanics. Compounding is asymmetric. A 50% loss requires a 100% gain to recover. That asymmetry is why risk of ruin is the real enemy. The biomechanics. Overconfidence and the craving for fast results push you into sizes your psyche can't hold through volatility. Your application is mechanical. You decide your maximum loss per position as a percentage of total capital. Then you back into position size based on where your invalidation level is, your stop or your thesis breakpoint. If volatility rises, your stop distance needs to widen to avoid noise, which means your position size must shrink to keep risk constant. If the market gaps through your stop, you accept slippage as part of reality and reduce future size. If you find yourself checking prices compulsively, your size is too big for your nervous system. You cut it. The failure point is pretending you can hold through anything while your position is sized for perfection. Habit 7 is you avoid high-interest, non-productive debt like it's toxic leverage. Poor behavior is borrowing for consumption or rolling balances while hoping income will fix it. Wealthy behavior is using debt only when the asset produces cash flow, the terms are stable, and the downside is survivable. Market mechanics. Leverage magnifies both returns and errors, and it interacts with rates. When rates reset upward, the same debt load becomes heavier, and forced selling becomes more likely. The biomechanics. Minimum payments create hidden volatility in your life, an obligation stream that tightens when you're stressed. Practical execution. If you carry high-interest revolving debt, your best investment is paying it down because the return is immediate, guaranteed, and risk-free. You set a payoff schedule and treat it like a mandatory position reduction. If the economy slows and job risk rises, you accelerate debt reduction because leverage becomes more dangerous in downturns. If you consider using debt for investment, you stress test. Assume a drawdown, assume income disruption, assume rates move against you. If the plan breaks under those conditions, you don't do it. The failure point is confusing optimism with a margin of safety. Habit 8 is you treat taxes and fees as controllable drag, not as background noise. Poor behavior is focusing only on gross returns. Wealthy behavior is optimizing net returns because net is what compounds. Market mechanics. Even small annual drags, management fees, taxes, slippage, compound negatively over time. The biomechanics. People chase visible wins and ignore invisible leakage. Application looks like discipline in structure. You use tax-advantaged accounts when available. You understand the difference between short-term and long-term gains, between ordinary income and capital gains, between taxable and sheltered growth. You reduce turnover unless you have an edge that justifies it. You choose low-cost vehicles for broad exposure and reserve high-fee products only for truly differentiated strategies. If you trade frequently, you track your true execution, spreads, commissions, market impact. If your strategy's expectancy is small, friction will kill it. The failure point is feeling sophisticated while paying unnecessary drag. Habit 9 is you run an information diet that improves signal to noise. Poor behavior is consuming financial content that triggers impulse, hot takes, constant alerts, social media charts with no context. Wealthy behavior is collecting a small set of high-quality signals and acting only when your rules trigger. Market mechanics. Most news is already priced. Your edge is not speed, it's preparation and process. The biomechanics. Dopamine loops make you confuse activity with progress. Here's how you apply it. You define your signal set based on your strategy. If you're a long-term investor, your signals are valuation ranges, earnings quality, balance sheet strength, and macro regime markers like rates and credit. If you're tactical, your signals include trend, volatility, liquidity, and positioning. If the market is whipsawing and your signals are mixed, you reduce size or stay in cash. If your signals align, you execute calmly because the decision was made before the emotion arrived. The failure point is reacting to headlines as if they're instructions. Habit 10 is you build repeatable systems and treat finance like operations, not like personality. Poor behavior is improvisation, new rules every week, inconsistent behavior, inconsistent risk. Wealthy behavior is process, rules, reviews, and continuous improvement. Market mechanics. Consistent application of a positive expectancy strategy compounds. Inconsistent application creates self-sabotage. The biomechanics. Under stress, you revert to default habits. If you don't install defaults, your defaults will be fear and greed. Now, you've seen the 10 habits as separate elements, but in this lab, you're going to see the unifying logic. You're engineering a system where time horizon is protected by liquidity, where risk limits protect compounding, and where decisions are triggered by signals instead of emotions. Most people miss this because they treat habits as motivational slogans. Professionals treat them as constraints that produce predictable behavior. Here's where most people stop, but here's the advanced layer. The advanced layer is understanding regime shifts and second-order effects, because the market you're trading today is not guaranteed to be the market you'll face tomorrow. Correlations break. Liquidity disappears. Volatility clusters. Assets that always bounce back can take a decade to recover if you bought at extreme valuations under an easy money regime that later tightens. The wealthy mindset isn't just be disciplined. It's design for regime uncertainty and avoid ruin. In practice, that means you stop thinking only about what can happen and you start thinking about what can break you. You run risk of ruin math mentally, even if you don't write equations. If your strategy can produce a 30% drawdown in a normal environment, you assume a 50% drawdown is possible in a stressed environment. Then you ask whether your cash flow and psychology can survive it without forced selling. If the answer is no, you reduce leverage, reduce position size, or increase liquidity. You also understand volatility drag. When an asset swings hard, even if it ends up flat over a period, the path can destroy compounding if you're adding and subtracting capital at the wrong times. Second-order effects show up when liquidity changes. If central banks tighten and credit spreads widen, weaker companies face refinancing risk, and equity can behave like a leveraged bet on solvency. If liquidity is abundant, speculative assets can levitate longer than fundamentals justify. But when liquidity reverses, the exit becomes crowded. Your response is not panic, it's preparation. You hold assets that can survive a tightening cycle. You diversify across drivers, not just tickers, and you respect that diversification fails if everything is exposed to the same liquidity factor. That's why the liquidity-first habit is not conservative. It's strategic. It's your antidote to the liquidity trap. You also upgrade how you use correlation. Most people diversify by owning many things. Professionals diversify by owning different return drivers. If your portfolio is all growth equities, meme stocks, and high beta themes, it's one trade disguised as many. In a risk-off regime, correlations approach one, and everything drops together. Your response is to balance exposures. Some assets that benefit from disinflation, some that benefit from inflation, some that are resilient in tightening, some that are opportunistic in easing. You don't need to be perfect. You need to avoid being one-dimensional. Now integrate this into a training plan so it sticks. You train finance like a skill, deliberate reps, feedback loops, and stress testing. You keep a simple journal that records the decision context, the signal set, the time horizon, the risk defined, and the exit plan. Not to be poetic, so you can audit whether your actions matched your rules. Over time, you track metrics that actually matter. Savings rate consistency, liquidity coverage months, portfolio drawdown, risk per position, turnover, and net returns after fees and taxes. You review weekly for process errors and monthly for allocation and regime alignment. If you made money by breaking your rules, You treat it as a failure because it trains the wrong behavior. You also backtest and simulate, even if you're not coding. You can do lightweight backtesting by reviewing historical charts and macro conditions to see how your rules would have behaved. You can paper trade to test execution without risking capital, but you treat it seriously. Same position sizing rules, same exits. Then you graduate to small sizing because the true test is psychological. If your system breaks when real money is on the line, you don't push through. You shrink size until your behavior matches your plan. Then you scale gradually. You combine tools instead of worshiping one. Valuation helps you understand expectations and margin of safety. Macro helps you understand the discount rate, liquidity, and regime context. Technicals help you manage timing and identify where invalidation is obvious to the market. Risk management ties it together because it determines survival and the ability to stay in the game. When these tools disagree, you don't force a trade. You either wait, hedge, or size down. You treat no position as a position when signals are unclear. To test under pressure, you do pre-mortems. Before you enter a position, you write down how it fails. Earnings miss, rate spike, liquidity crunch, correlation shift, sentiment unwind. Then you decide what you will do in each failure scenario. If the market does X, you respond with Y. If price breaks the invalidation level on heavy volume and broader risk is deteriorating, you exit and preserve capital. If price drops but the thesis remains intact and liquidity is stable, you add only if your sizing rules permit and your time horizon supports it. If the environment shifts, rates up, spreads wider, volatility rising, you shorten duration and raise quality. You're not forecasting, you're responding to conditions with a playbook. And here's the subtle detail that should make you replay this. Every single habit collapses into one operational equation you run without thinking. Your liquidity buffer determines your time horizon determines your asset choice determines your volatility exposure, and your volatility exposure determines your position size. Miss one link and the chain breaks. Catch the chain and the 10 habits stop being mindset and become a system you can execute on autopilot, especially in the one moment that matters, when the market moves fast and your emotions want to shorten your horizon.